That is to say, the startups, they are all clamoring for funding. Sources telling us that some founders do whatever it takes to generate magic metrics, so potential investors sign on. Telis Demos, so with me now, he co-wrote a piece in the Wall Street Journal. Telis, it is great to see you. Thanks for coming in.
Thanks for having me on.
So what kind of magic metrics are we talking about? I read your piece and it seemed like billings versus revenue is one point where there seems to be a little leeway.
Well, so revenue is what most people think of when they think about kind of the top line of a company. How much money is it taking in? And then obviously, how does that translate into profits? But we're talking about growing companies here. So if we're focusing on revenue, there are different ways that sometimes startups look at revenue versus how a traditional company does.
Okay, which is a great point, because when you're a private company, I'm not going to say the SEC doesn't care, because of course it cares, but it's a lot less, let's say, diligent than when you're a publicly traded company.
That's right. When you're not selling securities to the public, the SEC says, okay, you're dealing with sophisticated investors. They're on their own. You know, we're not going to make sure that every statement is sort of scrubbed to meet all of our standards. Obviously, you can't say fraudulent things, but we're not going to make sure that you're talking only about a very narrow set of things the way that a public company does.
So tell us, I pulled out a stat from your reporting, and it's last year's rate of 17%, the lowest for a full year since the year 2000. And this is talking about private tech companies before they go public. In other words, they're going public even when they're not profitable at the biggest rate in 15 years.
That's right. The focus really is on looking for growing companies, you know, and that's a focus on the top line, on revenue. You know, people aren't really concerned that the companies aren't making money today. The theory is that they'll make money down the line once the business gets to sort of full scale.
I'm so glad you said that, because as you referenced in your piece as well, Andreessen Horowitz saying, like, listen, if you want to just go by GAAP measures, the traditional measures, you're going to miss out, investors, on some pretty good companies. Is he just talking his own book, Mark Andreessen, or is there more to it?
Well, I think that certainly, you know, the way that VC investors, run their business is they're taking bets on companies that they think will be home runs in the future. And so, you know, they tend to look at things in a very different way than like a public investor might do for saying, okay, I want to make an investment that's good over the next 6 months or maybe a year time horizon. They're looking over several years. So they look at a company and they say, okay, I don't really care necessarily how much money is coming in the door today. I want to look at what's going down the road. And so they are willing to look at numbers like, you know, how many contracts a company is booking. Even if those don't turn into actual revenues, they want to say, okay, well, at least they've signed this many contracts.
Uber, Pinterest, a lot of the headline grabbing private tech companies do exactly what you're talking about.
That's right. They look at things like gross revenue. That is, okay, not just how much money necessarily comes into the company, but, you know, on the overall marketplace, right? How much money goes through Uber every day? Now, that might not necessarily be money that actually kind of Uber keeps, because some of it goes to the drivers, you know, some of it might be kicked back into, you know, refunds and things that go to customers and stuff. But people still want to say, okay, what's the size of this marketplace and how is it taking market share away from taxi cabs or, you know, people driving themselves?
All right. So tell us, you made a great point by saying the SEC is less concerned with private companies because their funding is coming from sophisticated investors. So point taken. That said, what are the most misleading terms? What are the ones, if we said, give us your top three, what are they?
Well, I would say, you know, things that people commonly misunderstand. Often they're talking about gross revenue versus net revenue. Gross revenue might be looking at, you know, again, every kind of dollar that's happening within a company's marketplace, right? So with Uber, it's like every dollar that's sort of paid through the app, even though not all of it goes to Uber. You know, for a public company to compare that to a public company, they'd be looking more at a net revenue. How much money goes directly to the company? Another thing that gets thrown out there is revenues when they're talking about bookings. Bookings, again, are,
you know, like expectations. Like, we think this is going to happen.
Well, it's more like, you know, we've signed a bunch of contracts, you know, maybe 3-5 year contracts, and that's a good sense of what our business is going to be. But, you know, those contracts might not pay out until 2 or 3 years from now. There might be certain clauses in the contract that allow, you know, a customer to get out of it. So it's a very different thing from like, okay, how much money actually sort of came in the door through these
What
things.
is actually in the coffers? Telis Demos, thank you. As always, great to have you with us.
Thanks, Deirdre.
He co-wrote this piece on the front page of the business section and the tech section of the Wall Street Journal.